Ladies and gentlemen, good day and welcome to MAS Financial Services Limited Q4 FY2022-23 earnings conference call hosted by JM Financial Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Bise from JM Financial. Thank you, and over to you, sir.
Thank you, Neerav. Good evening, everyone, and welcome to the 4Q23 earnings conference call of MAS Financial Services. First of all, I would like to thank the management of the company, Mr. Kamlesh Gandhi, for giving us the opportunity to host this call. From the management side, today we have Mr. Kamlesh Gandhi, Chairman and Managing Director, Mrs. Darshana Pandya, Director and CEO, Mr. Ankit Jain, the Chief Financial Officer, and entire senior management team of the company. We will first begin with opening comments from Mr. Gandhi regarding the business environment, and then we proceed to the Q&A session. Over to you, sir. Thank you.
Thank you so much, and good evening, everybody. I'm happy to be connected again for sharing the Q4 performance of the company. As shared with all of you, I think through the SEBI note and our presentation on the website, the performance of the company was very robust, as in line with our 2 decades of performance, what we have demonstrated over all these 25 years of working. And this was the first full uninterrupted year of working post-COVID. And taking that into account, the performance of the company in terms of AUM and PAT and in terms of growth stands at 29.55% in AUM and 27.5% in profit. So if you look at the performance for the whole year, and if you say the quality of the assets has been pristine at net stage 3 asset at less than at around 1.52%. One more achievement or one more milestone what we have crossed this year is crossing consolidated profit above 200 crores. The consolidated profit is approximately 206 crores of the company, which I consider is an important milestone. And we are just striking distance away from another important milestone, which we are very confident of achieving it this year, is of reaching and crossing 10,000 crores in AUM. I recollect the first 1,000 crores was done in 12-13. And if you take the year, 1 year out of COVID, so in a decade we have grown this book 10 times. So we were 1,000 crores in 12-13, and we are confident of crossing 10,000 crores in 23-24, which translates into almost a 25% CAGR over a long period of 10 years. And I think all of you will agree that this was a very, very eventful decade. Starting, if you take into account the various crises in the financial sector, and the last one, but not the least, the health crisis, which has devastated not only India but the whole world. So I'm very happy to share that despite of all these cycles, the company could demonstrate a 25% CAGR and a 10 times growth. And we have very strong enablers for the same even going forward, in terms of high capital adequacy, in terms of the niche expertise, in terms of prioritizing in the quality, profitability over just growth, giving us not the growth but the development. And once again, 10,000 crores will be a milestone which I think will once again fade away the way 10,000 crores faded away in memory. And as articulated in all our communication, that every time we reach a milestone, we will just begin. So this was the achievement on the company as a whole, while my colleagues Darshana and Ankit will take you in detail. But just on the strategic front, I come on the distribution side, that is creation of the asset. We continue to focus on the MSME segment, which constitutes more than 80% of our business. We have the potentiality to serve more than 9,000 centers across the country. And our focus will remain on MSME segment through our direct distribution and through our very robust NBFC distribution channel also. The distribution model through NBFC also witnessed a very strong performance, 11 and a half, almost a 12 years old module now, with a cumulative disbursement of more than 20,000 crores and loss given default of less than a percentage, has demonstrated a very high quality intermediation. So we'll continue to strengthen our distribution for the asset creation on both this on both this distribution network. Having said that, our direct distribution network is fast increasing in terms of percentage and contribution. This year it is contributing 63% and will continue to contribute more going forward. We all know that technology plays a very important role, and at MAS we are aware and working very hard on that. We, through our internal team of more than around 35-40 people, are working hard to see to that how we address the technology that increases efficiencies right from loan origination to decision making to transactions. And I think that will add to the efficiencies going forward. I would like to inform all of you, which was I think shared on our website also, but I'm very happy to inform that we have formed a management advisory committee, an advisory committee to the board, consisting of 3 eminent people, starting from that Dr. Rajiv Kumar, who was the ex-NITI Aayog Vice Chairman and a very renowned economist, recently being conferred upon by one of the highest award by the government of Japan for his contribution towards infrastructure during his tenure as a NITI Aayog Vice Chairman. I think his insight will provide a lot of vision to the company for its next growth of 10,000 crores and beyond. The second eminent person is TTS Srinivas Raghavan, the ex-MD of Sundaram Finance. In our NBFC sector is known as the father of the NBFC industry, having demonstrated a very quality, pristine growth over many years and a stalwart of the industry. And Mr. Paliwal, the ex-ED and the current CEO of Small Finance Banks Association. So I think I'm very thankful to all the 3 eminent personalities for having very readily agreed to join the advisory board, and I am confident that they will contribute very positively as we scale new heights and enter new horizons of 10,000 crores and beyond. So this is on the HR side. We continue to remain a strong team of 2,500 people, and very proud to share that there is a minimum attrition at the top and the medium level. As I've always shared, that we have a very strong team, core team of more than 35 to 40 people who have been with me since the inception. So we have succeeded, and we have failed and succeeded collectively. We have learned collectively, and that has put the company in a very good state, along with our focus on lateral recruitment also going forward. So that was on the HR side. So from me, just to reiterate that it was a very robust and a strong quarter. We see a very strong enablers for us to continue our growth anywhere between 20 to 25% going forward, and crossing an important milestone of 10,000 crores this year with keeping fundamentals intact. If you look at our capital adequacy is more than 25% with 21% as Tier 1 capital. And it is very important to mention here that post our IPO, there is almost 5 years, from close to 3,000 crores will be almost 10,000 crores this year, mainly through internal accruals. And I understand all of you will agree that in the lending business where capital is the base and growing through internal accruals, that too with strong capital adequacy, speaks of the robustness of the operations and the asset creation. I'm happy to share that we have declared a dividend of 18.5%, the final dividend. That takes the dividend for the whole year to 36.5%, which amounts to 10% of the payout of the current year PAT, in line with our strategy which has been followed since last few years. So with this, I would like to hand over to Darshana to take you through the numbers in detail, while the numbers are with you. But just to refresh, she'll take you through the numbers in detail, which are important for all of us to understand. Darshana, please take it.
Yes, sir. Thank you so much. Good afternoon, everyone. I'm happy to share the numbers for Q4 23 and the financial year 22-23. And as mentioned by Kamlesh sir, this was post-COVID, this was the full year, which was without any abnormal situation. So we could grew our book by 29.55%. And if we look at the configuration of the portfolio, micro-enterprise loan is now at 3,874 crores as compared to 3,249 crores, which is 19.23% growth in book. SME loan has grown by 31.29% from 2,274 crores to almost 3,000 crores. Two-wheeler loan has grown by 46.88%. Which is now 554 crores as compared to 377 crores last year. Commercial vehicle loan has grown by 7.90% from 345 crores to 372 crores. As such, we have grown our retail book in our commercial vehicle loan portfolio, but there are few instances of pre-closure in our NBFC book, and hence the percentage is 7.90% growth. For SPL loan, it's a new segment for this year, so we don't have any comparative figures. The book size is now 305 crores. If we look at the total income on quarterly basis, it has grown by 47.13% from 183 crores to 270 crores. Profit before tax has grown by 17.37% from 60 crores to 70 crores. Profit after tax on quarterly basis has grown by 23.44% from 45 crores to 55 crores. And if you look at the annual numbers, total income has grown by 44.44% from 657 crores to 949 crores. PBT has increased by 25.27% from 211 to 264 crores. And profit after tax has grown by 27.55% from 157 crores to 200 crores. I'm happy to share that we could maintain the quality of the portfolio. So now our gross stage 3 asset is 2.15% and net stage 3 asset is 1.52% as compared to 2.23% gross stage 3 and 1.60% net stage 3 as on December 22. And we still hold 0.31% of our total on-book asset as management overlay. Now coming to our housing housing portfolio performance. There also our book has grown by 31.57% from 314 crore to 413 crore. Total income has grown by 34.33% from 9 crore to 12.40. Profit before tax has come down by 9.28% from 1 crore 87 lakhs to 1 crore 70 lakhs. That is mainly because of increase in our operating expenditure, because we have expanded our branch network, and accordingly the number of employees have also increased. Profit after tax has come down by 8.62%, 1 crore 50 lakhs to 1 crore 37 lakhs. And if you look at the annual numbers, total income has grown by 20.64% from 36 crore to 43 crore. PBT has increased by 30% from 6 crore to 8 crore, and PAT has increased by 29.66% from 4 crore 89 lakhs to 6 crore 34 lakhs. So this was regarding the performance of both the companies. Now I'll request Ankit to take you through the liability management.
So before Ankit joins, I missed out on apprising all of you on housing finance. As I always shared with you that housing finance is going to be one of a strong value accretion for the company going forward, and that also we have registered a 30% growth, and this year we also anticipate a 30 to 35% growth. We see this company growing to 1,000 crores in the next year or two and generating value for the company going forward. So we are happy to share that we are confident about the growth in our housing finance company also. That remains well. The quality of the asset as shared remains benign at around 0.6% of net stage 3 assets, and any growth capital can be contributed whenever required. So with all the strong enablers of large market size, niche expertise being developed and gaining the traction in terms of disbursement, we are sure that the housing finance will register a robust growth this year. With this, I'd like to hand over to Ankit Jain to apprise you on the liability side of the
Yeah, thank you, sir and ma'am. Hello to all. To elaborate on the liability management, so this quarter we were able to maintain an average liquidity buffer of around 650 to 700 crore, and along with that, unutilized facility of around 375 crore. In addition, the company has sanction on hand through various instruments of more than 250 crore. In the last quarter, company did around 555 crore direct assignment transactions with various banks, and we further have around 1,000 crore sanction on hand, which we will be utilizing during the next 2 quarters. In the last quarter, company did around 24 crore co-lending transactions. The company has tied up with 3 banks, and we are in discussion with few other banks for meaningful and sustainable co-lending tie-ups. We aim to maintain around 20% to 25% of AUM as off-book through direct assignment and co-lending transactions. We have cash facility of around 1,700 crore, out of which the utilization generally remains around 65% to 70%, and rest portion is always kept as a liquidity buffer. We successfully rolled over around rupees 1,450 crore short-term working capital loans, which are sub-limit of these cash credit limits. We raised rupees 755 crore term loan during the quarter. This term loan is generally for a tenure of 3 to 5 years, which helps us to further strengthen the asset liability maturity pattern. Our structural liquidity remains strong, whereby there is no negative impact on liquidity, and the cash flow in all the cumulative buckets remain positive. On the capital adequacy side, we have remained strong at 25.25%, with Tier 1 capital of 20.79% and debt equity of around 4 times this year. In the March quarter, we raised around 100 crore subordinate debt, which qualifies as a Tier 2 capital and help us to further strengthen the base of capital structure. The cost of borrowing for the quarter was around 9.26%, and for the whole year was around 9.02%. This is majorly because of our effort on negotiation of cost while we raise funds from through various instruments and through various institutes, as well as because of the lag effect of MCLR-based borrowing. We see that this cost of borrowing to settle around 9.5% in the coming quarters. So this is on the capital and liability management, and we are open for the Q&A round. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello.
Hi.
Hello. Yeah, am I audible?
Yeah.
Sure. So there's 3 questions. One, with the cost of funds having gone up, and also competition going up on the MSME side, which is one of the areas where our focus has been and which has been doing well for us. So how do we see the scenario ahead, both in terms of growth and also with terms of, whether we will continue to grow aggressively in this particular segment? How do we look at this segment? That is question number 1. Second is, shall I ask all the questions or shall I go one by one?
You may carry on. You can ask all the questions.
Okay. Second is with regards to the NIMs. Again, with the cost of funds up, and now it's almost about 4 quarters for the funds. Costs have gone up, and we have been able to pass on certain part of it. But how do we see the scenario ahead, going ahead in terms of maintaining our NIMs? Lastly, the salaried personal loan segment here, we have done exceptionally well in last 1 year, practically from nothing. We today have almost a 300 crore AUM in that particular segment. So, two things. Do we still feel that the kind of aggressive growth which we have done in this segment will continue with that on this base of 300 crores? And since this is our first experience with this segment, how do we see the asset quality for this particular asset class? Thank you.
So starting from the first question on, I'll club 2 questions on rate, cost of funds and means. So if you see last year, as Ankit shared, that because of our immaculate track record with various lenders, we were in a position to negotiate tough with them on the premium they charge on MCLR, and hence we were in a position to maintain means during the most volatile period of close to 7%. As we go forward, right from the last year, we had endeavored to start repricing our assets accordingly. And now with the rate cycle being, the hikes being paused, but nevertheless being MCLR linked, there will be some rate hikes being passed on to us. As Ankit told that from the marginal cost of 9.25, we might see a 9.5% this quarter. But still, with the repricing and with a better negotiation with the lenders, we are confident of maintaining means anywhere between 6.75 to 7% as maintained over the years during this year also. On the MSME growth piece, let me share with you 2 basic things here. That this is a very, very huge market to be served. One, so the competitive landscape does not put that stress on the rates. It is not about getting the market size. If I talk about what is my market share in MSME, it will be difficult for me to give any number in an integer. It will be fraction and so less that can't be calculated. So the size of the market is so huge, and secondly, it is not rate sensitive to that extent that a 0.5% or a 0.5% will play a very important role in getting the assets the way we want. This has been our experience over all these years, and wherever we have seen the cycles of higher rates, higher inflation, or various other headwinds, we have been in position to understand this segment nicely and navigate through that. So that was on your MSME piece on the growth and the rate and the needs. On the salaried personal loans, if you see 300 crores as a total of 9,000, close to an 8,100 crores of AUM, is around 4% of our total AUM. And we would, as rightly remarked by you, will grow cautiously. Any new product we don't grow very aggressively. But at the same time, we need some critical mass to assess the product performance. And we think that this was a critical mass we need to build up to get the product performance. And we'll be building up on this depending upon our experience we have from time to time on the asset quality and the learnings and the unlearnings that we have to undertake. But having said that, as a strategy, salaried personal loans will not be more than 5 to 7% of our total AUM for next few years. This is what I envisage right now, unless it starts exhibiting excellent risk-adjusted returns. So this is my response to all the 3 questions you asked.
So just a clarification or just a added thing to the overall MSME, SME and two-wheelers. Given the high rate of interest rates today, you are comfortable at today's rates to lend and grow at around 25%? Because generally our principles, or we have always maintained that we will grow, but we will always grow profitably. So given the high rate of interest, you will maintain that growth rate of around 25%, in spite of maybe sometimes getting concerned about the asset quality?
See, a rate hike means what are we talking about? We are talking about a rate hike of around 0.25% or 0.3% to be passed on to the borrowers. I think that is not going to affect the quality. And secondly, this is, let me tell you, pass through various cycles where the rates were much more higher initially for the same segment, but still we had managed the good asset quality within those rate brackets also. So this marginal rate hike, I don't reckon can have any impact on the asset quality. At the same time, see, in lending, at whatever rate you lend, you have to be cautious and you need to understand what are you have to be very circumspect on your credit underwriting. So today only I shared with one of the channels that while we would like to determine growth, but at the same time we don't mind discovering the growth at the ground level. So I always give a range-bound growth target between 20 to 25%. We might overshoot it if we get a good opportunity as we did this year to register 29% growth.
Sure. Thank you so much, sir, and all the best.
Thank you.
Thank you. Next question is from the line of Jaiprakash Toshniwal from LIC Mutual Fund. Please go ahead.
Good afternoon, sir. Thank you. Sir, can you just more elaborate on this corporate advisory committee in terms of what is the term of the committee, how many times it will meet up in the year, and what is the scope?
So the term of the committee it will be renewed every year, and the scope is more on strategic in nature, understanding the company's strategic intent and advising us on, after looking at all the execution parameters, advising us on what best can be done to align our execution in lines of strategic intent that the company envisages. And secondly, they will be very helpful in understanding and giving their vision that what exactly are we supposed to do as we grow in scale. And that will, and advising on any matter which is which is referred to them in terms of increasing the efficiencies or in terms of any hiccups we face during our execution. So we have taken the committee members from the varied phases, from the varied sources, that is one an economist and another person who has run the NBFC at a scale for a very long time, and the one from the regulatory aspect. So even guiding us from the regulatory aspect will be useful by one of the committee member who happens to be the ex-executive director of RBI. So it will meet 4 times in a year. It will meet every quarter post results at the mutual convenience of the board members and the committee members, but not limited to 4 times. It can increase on demand whenever it is required.
Okay, interesting. Thanks. The second question on the personal loan segment, you mentioned that you have reached through a critical mass at this point of time. Is it does it mean that you have some more data on the customer or how the product has performed? Anything which you want to highlight on this product per se?
It's very early to know the trends because this was the first year of the critical mass, and as the time progresses, we'll be in a position to understand that, and hence that is what I was referring to, that we will be watching the portfolio this year very closely. As of now, the portfolio has been satisfactory, while we learn every month on what has to be amended in terms of our credit screens from the early bouncing and all what we see. But currently it's difficult to talk about the trend of the portfolio. But we are very circumspect ab initio, and we would like to be like that we like to be there for as long as we have sufficient experience and data to scale up to a certain size. So currently the portfolio quality is good and it is quite satisfactory. But going ahead, we'll have to see that how it behaves over a period of time.
Okay, and so just last question on. We planning to have our own feet on the street and on branches to cater to the MSME segment. So can you just elaborate more? Where are we on that journey, and how much? What is the target for the FY24 for that on that journey perspective?
So I'll break this into 2. So we are rather slightly shifting our focus to the SME piece, Whereas micro enterprise loans, we have been doing it since many years, and it is being distributed through our NBFC partners also. But on the SME piece, we intend to have specialized branches in the country, whereby we'll be having close to 50 branches in total, where they'll be distributing only SME loans, and there will be feet on street being employed there, and there will be close to around 350 to 400 guys working there in various capacities on origination, credit, and collection. That will be the total addition to this segment. And the ticket size will range anywhere between around close to 20 to 25 lakhs of rupees. And secondly, in this part of the business, we are happy to share that because of the technological advancement, the credit assessment has relatively become more accurate, and at the same time, the turnaround time has also reduced. If I give an example, we are in a position and we finance to the SME where we have access to direct GST data and their banking data and the credit scrub we get from time to time. So helps us to gauge their cash flows, their income, their credit history. And so far our experience has been very good on early delinquencies as far as this segment is concerned. While we'll continue to do the MEL the way we have been doing so far.
Okay. Thanks, sir. I'll come back in the queue, sir. Thank you. Thanks. Thank you.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Ankit Gupta from Bamboo Capital Partners. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers for the entire year. So, sir, I wanted to ask you, about the measures that we are taking to improve our cost of borrowing. With our size growing and, our direct presence also increasing, how do you think, we can lower rate of borrowing? And, I think that will also come from upgrade in rating as well. So, your views on reducing the cost of borrowing and measures we are taking to do that?
So reducing cost of borrowing is a very continuous exercise. So it is we always try to get the liability at the cheapest available rate while keeping one eye on the amount we need to raise. So given our track record, let me tell you that we are rated A plus by CARE and AA minus by Acute. I can't predict for rating agencies, but fundamentally we are almost there for a rating upgrade, but we just need to wait and watch the credit bureau's perspective. So we continuously strive to see to that how we reduce the fund through variety of resources and keeping the powder dry for at least 2x or 3x the amount we need. So what happens in liability, your capability to reject an offer is very important for getting the right rate. And how far are you placed in terms of the timing? Let me share with you that we are always 2 to 3 quarters ahead in terms of sanctions. As Ankit told, you already have more than 1,200 crores of sanctions in various forms, which is more than sufficient for our Q1. And by Q1, we'll be having another sanctions will be okay for us up till Q3. So being ahead of the curve in terms of requirement and having more sanctions on hand, having diversified source of funds in terms of, say, for example, we have cash credit limits carved out to demand term loans. We have term loans. We have term loans from PSUs, private banks, developmental financial institutes. Then we have capital market borrowings also. Up till now it was through MLD, now it will be through NCDs. And we have assignments and PTCs can also be drawn. So the various sources of funds, being ahead of the curve, keeping the powder dry for more amount, and then choosing and picking the right offers is the key. So it is all about execution.
Sure. But just if you look at it, our bank borrowings largely, term loan and cash credit, which constitute around 68% of our total borrowing. And last year also, if you look at it, as on March 31st, 2022, the amount was around, the proportion was around 68%. And so, do you think when we grow grow to, let's say, 15, 20,000 crore kind of AUM over the next 3 to 5 years, the proportion of bank borrowing will come down, and hopefully by that time we'll be upgraded to AA category, our proportions of NCDs and CPN, our ability to access the bond market will also increase, and what are our plans for that?
Definitely. See, once again, it's a question of size. At a particular size, diversification to beyond a particular extent is not possible. Say, for example, I want a term loan, and here is State Bank of India telling me that, okay, I'm very happy with your working, and you will have to get a sanction from us of 500 crores. There I cannot go and tell that, no, I want a diversification and I'm not going to use this resource. So to the maximum extent possible, practically, we have diversified. And as we grow, automatically we'll get the room to diversify. Because what happens that while we need money, even bankers are target to lend to good companies and good parties. So if you see during the quarter end, my finance team is hard pressurized for taking the disbursement of the various sanctions on hand. And it is at times difficult to convince all of them to delay to the next quarter, or to some of them we might have to dismiss them by not taking it. So diversification will definitely happen, which will happen with size, and as you rightly remarked, with increase in rating, all sorts of diversified resources will be explored, and that will help to reduce the cost also.
Just literally asking, let's say if you have to access the bond market now, for a 3 to 5 year kind of NCD, plain vanilla NCD, and compare that with a 3 to 5 year term loan, like what kind of cost advantage do we get when we access the bond market, or when we are accessing the bond market currently?
I think my understanding is that the bond market will be at least 0.5 to 0.7% higher as compared to the term loans we raise, because of the various costs involved in raising those funds.
Sure. And I think that difference will actually become negative, or bond market might become cheaper for you when you grow in size and hopefully get a rating upgrade to AA category.
Yes.
Sure. Okay. Sir, my second question was on the branches. If we look at our branches that we have opened in last year, so the major branch expansion has come through our existing states where we had larger presence, like Gujarat, Rajasthan, Maharashtra, and Madhya Pradesh, and some of the newer places like Karnataka, Tamil Nadu, Delhi, and Chhattisgarh we just entered. So those haven't seen much of expansion. So what kind of opportunity size is available in our existing areas, like 3-4 states where we have larger presence, and what are our plans for geographical expansion in the new states that we have entered, and any plans to enter further new states in FY24 or 25?
See, it is all about the intention of the company to grow in a particular center where we have started afresh. So all the new branches will start gaining in disbursements over a period of time once we have the experience, the right team, the right understanding, demographic understanding, which only comes through working. So with all our new branches being opened at various states, we'll start gaining in traction this year. And we would like to be ahead by around 2 to 3 quarters in terms of our requirement of assets when you open new branches. So that is where I told you shared with all of you in the opening remarks that we contemplate to have more than around 175 branches this year, up from 150 branches. That is in sync with our requirement, not only for this year, but up to Q1 or Q2 for the next year, as I see right now. Then later on during the year, as the year progresses, it can increase or decrease depending upon the asset what we can create. But at the same time, let me tell you that we are keen to expand our distribution, which can be done anytime. But the distribution will be done in such a manner whereby the quality of the assets and the risk-adjusted returns are maintained. So keeping all these things in view, we'll be expanding to newer geographies, newer branches, which is always available to us.
Thank you. Ankit, sorry to interrupt you. I'll ask you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to one question at a time. The next question is from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, thank you for taking my question. My first question was on the housing finance side. The growth NPAs of the stage 3 assets, they've been inching up over the last 4 quarters or so. Anything on the asset quality side that, we should be aware of? I know how's the delinquency rate over the last few quarters?
It has to be a range bound, and as you grow, if I share with you on a certain book size to keep delinquencies up to a certain level is possible, but as you grow, it will be range bound, but within the acceptable levels. If I share with you the acceptable levels in affordable housing is anything less than 2%, but we are currently at around 2%, and as we go, I think it will marginally increase, but it will be in sync with our planning, in sync with the strategic intent on the price structure, that is ROA3, what you call it. And currently, in the current portfolio, there is nothing which we should worry about, because if you see the performance in terms of the net stage 3 assets, is pretty robust as compared to the industry standard. So a range bond is we can expect a range bond net 3 assets which should be less than 1% up till there 500 to 1,000 crores, and it can be between 1 to 2% as we grow above that.
Got it. Okay. And in terms of the loan books, you said it's up to 5 million rupees in residential and 10 million in commercial. So the profile of these customers, do they overlap a lot with our SME lenders? I mean, just trying to understand how much of cross-selling opportunities there are, or is this a very independent base?
Currently, it's a very independent base, because while we might get an opportunity, the problem will be on the eligibility. Because as a lender, how I would like to go beyond an exposure on a particular party is very important. So in our class of the borrowers, the loans usually are sequential in nature, that he completes one loan and then takes another loan, or has completed a major portion of the first loan and then goes for the second loan. So the cross-sell is always available to us, but once they complete one side of a loan, or they complete one side of the loan substantially. So it has to be looked from that aspect. And if I share with you, currently our cross-sell percentage is not that great, and that is only because of the limitations on that the credit faces on extending more loans or fresh loans to them.
Okay, understood. And while we give loans of up to 50 lakh, what is our average ticket size, and what is the mix between residential and commercial, and who are our main competitors out here? I'm guessing we are doing mainly in Gujarat right now.
Our housing average ticket size is 7 lakhs of rupees currently, and you are right that the majority is in Gujarat. The next is Maharashtra, and we also started exploring Madhya Pradesh and Rajasthan. So the ticket size will be around 7 lakhs of rupees.
And our housing portfolio is around 82%.
Okay, and the 18% commercial is mainly a LAP?
So 16% is commercial, and around 3% is project funding. So and the non-housing commercial part is both LAP and loans to purchase the shops and or commercial property.
Okay, and our breakup between salaried and non-salaried?
So right now we are not having those numbers with us. We can share it offline.
Got it. Okay. Just one last question on the on the main book. Our OPEX ratio had gone up significantly last year as we invested into the branches, but now it seems to be peaking out. So can we expect like some kind of leverage maybe next year as we get more efficiency and scale up on the new branches that we started in FY23?
No, definitely. So from the branches which has already been opened this year or the last year, we'll definitely gain on critical mass and will add on to reducing our OPEX. But at the same time, we'll be opening up new branches. So as long as we are in that cycle of opening more and more branches, I think the OPEX might increase a little bit. But overall, on an year basis, what we will strive to do is that we will try to keep the net ROAs anywhere between 2.75 to 3% and plan our activities accordingly.
Okay. Got it. All right. Great. Thanks so much.
Thank you.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Pratik Pai from ICICI Bank. Please go ahead.
Yeah, I wanted to understand what would be the asset quality going forward. What's the guidance on that?
I think as of now, we are confident to maintain it at a sub 2% level or as far as net stage 3 assets are concerned.
And what about gross? How much would be the gross?
So it will be range bound. Net will be anywhere between 1.5 to 2%. Gross can be anywhere between 2.25 to 2.75%.
Okay, thank you.
Thank you. The next follow-up question is from the line of Jaiprakash Toshniwal from LIC Mutual Fund. Please go ahead.
Hi, sir. Thanks. Sir, on my earlier questions about SME branch, you mentioned that you're opening 50 branch. What is the time frame for this 50 branch?
I think 50 will be in total. We already have around 20 branches at place. So out of that, 30 new will be opened. And I think most of them will be opened this year or latest by Q1 next year.
Okay. Thanks, sir. Thank you. That's it. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Sanjay Ladda from Watson Research. Please go ahead.
Hello.
Yes, go ahead.
Thank you so much, sir, for giving me the opportunity. So I have a couple of questions. First is our sourcing intermediaries, which used to be 372 in CV and 312 in two-wheeler in FY22, have reduced to 268 and 242 in FY23. How should we read this, and any color on that side?
Number of partners you are talking about?
Yeah, the sourcing intermediaries partner.
So that sourcing, let me tell you who are the sourcing intermediary partners. When you talk about CV intermediary partners, we are mainly into dealing with brokers who have access to source, and they also have the stocks of used vehicles. So that is a very dynamic thing. As we grow, it can increase and decrease depending upon the assessment of the intermediaries we do from time to time.
Okay. And my next question would be, our 31 to 60 DPD has increased quarter on quarter from 0.7 to 1.1%. And in this quarter, our credit cost has increased. So what is the outlook for the full year, or any guidance on that side? And how should we look at? Thank you.
So if you see overall quality of the assets, what we concentrate is on maintaining at least 90% plus on current, and then if you see the focus on the 90 DPD, which has been well maintained. Within the buckets, the percentage may vary, and it will vary as we go ahead. But in terms of the credit cost, as we say, your credit cost anywhere around close to 1% next year.
Okay, thank you, sir.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Preet from Wealth Advisor. Please go ahead.
Good afternoon, everyone. One aspect I wanted to understand, Kamlesh bhai, was related to the digitization that's going on, and how that can be a threat to mass in terms of how banks can go after the kind of segment that you are into, say similar to what happened with gold loan. So what is your sense of that? I understand the market is large, but at the same time, there will be a set of borrowers that you are interested in. Would increase in digitization make it easier for others to also get to that same set of borrowers?
So just to answer the question in two parts, if it's digitization, we are also in process of adopting and will adopt the digitization to the maximum level possible to serve our class of the borrowers. So it will not be an added advantage to any other lenders, and we don't have that. And secondly, digitization has limitations in our type of borrowers if you want to control the credit cost. Because when you talk about digitization, let me take you to the three basic aspects of digitization, mainly sourcing, the credit decisioning, and transaction. And the most important, if you talk about mass, we are already there in terms of sourcing internally, because digitization is a two-way traffic. The borrower should also be well versed. And in terms of transaction, right from day one, we are a banking-based disbursement and banking-based collection. So what it comes to the point and boils down to credit decisioning. Now in credit decisioning, if you take digitization as an aid to manual credit decisioning or as an alternative to manual credit decisioning is the point of debate. And when it comes to alternate when it comes to the point where credit decisioning is taken as an alternate to human credit decisioning, the portfolio quality for across the fintechs has not been that great, and I am afraid that it's a very long-term journey. If I talk about one of the quote of Amazon chairman, he told that digitization and AI, overnighting AI is 10 years. So it is to replace human intervention in credit decisioning altogether, I think can be done, but it comes at a cost which the lenders cannot afford as of now. So as an aid to credit decisioning, we are already using it. So in terms of we have number of tabs with API providers, we have number of API ties, we use account aggregators. So to summarize, to drive the point of, we will not be working at a disadvantaged positions on digitization. So we'll be at par as to what the best practices can be in terms of sourcing this and serving this sector.
Right. So what I was trying to get to, Kamlesh bhai, is that the banks, for example, right, will also have the ability to do exactly what you guys are doing with more digitization available or more aggregators available. So do you see any kind of increase in competition from them, similar to, say, what happened with gold loans?
I think as far as the type of the segment whom we serve, it is concerned, once again, the huge market size. And number second is that not only one lender can satisfy the borrower's requirement, and not only one lender will like to take the complete risk on a singular borrower. So competition from the bank has been since long. The customers whom we are serving already have a banking relationships with more than 1, 2, 3 banks. But every lender comes with its own expertise, and every lender has a limited appetite for risk on a particular borrower. So with this practical aspect, every lender finds a place in the borrower's liability management, provided you give better services, provided you understand this segment better. The problem in this segment is not how much asset you can create. The problem in this segment is that what quality of assets you can create. That is the biggest problem. So as long as you are focused on quality, the size of assets is never going to be a problem for any of the lenders.
Thank you. My second question is regarding that you had mentioned in your past calls that you borrow at MCLR, right? Is my understanding correct?
We borrow at MCLR based borrowing.
So majorly when long-term loan, it will be linked to a 1-year MCLR.
That's correct. So my question is that when the rate card when the rates start reversing, does that put us at a disadvantage?
Yeah. So that is what Ankit was alluding to, that marginal cost of borrowing from 9.25 might increase to 9.5% as that reset happens. But at that point of time, we would have the advantage of having time to reprice our assets and also to negotiate hard with the banks on the premium they charge on MCLR. And that is where combination of our negotiation with the banks on lending rates and the negotiation with the borrowers on the lending rates and with the lenders on the borrowing rate, we think we will be in a position to maintain our NIMs, as we demonstrated last year.
Gotcha. Thank you so much, Kamlesh. All the best.
Thank you.
Thank you. Next question is from the line of Ankit Gupta from Bamboo Capital Partners. Please go ahead.
Yeah, thanks for the follow. Kamlesh, if you can give some guidance on, how do you see the NIMs panning out for us for FY24? Hopefully, the interest rates have, topped out and, we shouldn't see further increase in the rates. So, what are your views on NIM trajectory for FY24?
I think we'll strive for anywhere between 6.75 to 7%. As you say, this year we have maintained 7%, and we are confident of being very close to that.
Sure. So, some compression that we have seen in Q3 and Q4 of this year, do you think, we should be able to reverse that hopefully by Q2, Q3 of next year, next financial year?
When I talk about range 6.75 to 7%, this includes everything. That initially it might be little lower and then we pick up as we go ahead.
Sure.
And we'll be working on repricing our asset also, and at the same time we'll be working on how to be more efficient on operations. So we'll see how.
Sure. Thank you, Anish.
Thank you very much. And now hand the conference over to Ms. Apurva Deshmukh for closing comments.
Good evening, everyone. On behalf of JM Financial, I would like to thank the entire senior management team of Mars Financial Services and all the participants for joining us on the call today. Thank you and goodbye.
Thank you very much.
Thank you all. Thank you.
Thank you very much. On behalf of JM Financial Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.